Hello everyone, this is Arnaud Delapierre and I am delighted to welcome you back to my channel specialized in dividends in stock market. In this video, I propose a topic that is dear to me, how to select high dividend stocks. We will discuss a method that helps identify solid companies capable of paying attractive and regular returns. Our goal is to grow your portfolio by considering financial stability. Stay until the end, and if you like the content, subscribe and leave a thumbs up to support the channel. Let's start with the basics. What is a dividend? It seems quite simple, but it's important to go over the basics. It's the portion of the profits that a company gives back to its shareholders as a thank you for their trust. Established companies like to offer dividends to attract and retain their investors. Receiving a periodic payment is motivating and can provide an extra source of income in the long term. However, a generous dividend does not always mean good deals. There are several aspects to consider before rushing in. In the rest of this video, we will detail these points to better company. Better guide you in your reflection. The first data point to study is the regularity of dividends over time. A company that manages to maintain or increase its payments naturally inspires confidence. Also, observe the payout ratio that reveals the proportion of profits dedicated to the dividend. A percentage that is too high may indicate a risk of downward revision, as the company might struggle to generate enough profits to continue paying as much in future financial periods. At the same time, examine the overall financial health, including debt, cash flow, and growth prospects, to anticipate the solidity of future returns for your investments. Before continuing, I would like to tell you about an application, Notrade, available for free on iOS and Android. It is a platform designed to give you reliable trading signals with a pleasant interface and powerful tools. Whether you are a beginner or experienced, or even a professional, you will appreciate its ease of use and the precision of these indicators. With a few clicks, you spot trends, receive alerts, and can refine your strategy. Its goal is really to make the task easier without sacrificing accuracy to know when to enter and when to exit the market. It's a valuable tool and support to enhance your market analysis. Let's get back to our dividend stocks. It is important to verify the consistency between the profits and the amounts distributed. If a company consistently distributes more than what it earns, it may have to reduce its payments later. Also, check its capitalization and, if possible, its stock market history. Very young companies sometimes offer fewer guarantees. Sectors like utilities or basic consumer goods are often known for providing steady dividends. Betting on these well-established pillars remains a good approach to secure part of your income. We often differentiate between cyclical companies and so-called defensive ones. The former cyclical companies have results that fluctuate according to the economic situation, which can result in variations in dividends. The latter, notably in food or health, show greater resilience during difficult periods, allowing them to maintain their distribution. To limit unpleasant surprises, it is recommended to diversify your investments to avoid relying on a single asset, no matter how attractive it may be. This distribution allows for better resilience against potential downturns and helps maintain a steady income flow. You may have already heard of Dividend Aristocrats. This term refers to companies that have increased their dividend every year for at least 25 years. They are generally recognized for their stable policy and prudent management. For a beta investor, it is a reassuring entry point if the goal is to receive regular payments and see income grow over time. However, one should not deviate other, less established companies that might be promising. The important thing is to thoroughly study their fundamentals, prospects, and financial stability before taking a position. Taxation is an aspect not to forget. Depending on your country, dividend taxation may vary, and certain schemes, such as the PA in France, offer advantages not negligible. This tax situation can reduce your net yield, so it's better to take this into account to avoid disappointments. Moreover, some investors prefer to reinvest their dividends directly to buy more shares, thus creating a compounding effect. Others choose to receive dividends in cash to have a regular income stream. The choice obviously depends on your overall strategy and goals. Personal. To get your hands on gems, you can draw up a list of companies that interest you and regularly monitor their financial results, official announcements, and expansion projects. The idea? Stay informed of the potential trajectory of profits, as any significant changes could affect the dividend itself. Also, monitor the payout policy. If management mentions a change in its strategy, try to assess its impact. By maintaining a periodic review of your positions, you can better anticipate and, if necessary, adjust your choices to preserve the stability of your income. When you evaluate a high dividend stock, free cash flow is often more revealing than simple profit. It is the actual cash remaining after operational expenses, providing more latitude to compensate shareholders. Furthermore, look at the debt. A high level of debt can become problematic in case of rising rates or interest rates. Not to forget the history, because an attractive dividend policy is never a matter of chance. Behind good recurring returns, there is often rigorous management and a well-established vision for creating value within the company. Do not limit yourself to accounting figures. The ability to innovate and the and adaptability of a company is also decisive. If it knows how to open up to new opportunities or renew its products, it will have a better chance of maintaining an enticing dividend. However, beware of offers that seem too good, especially in highly speculative sectors. Check the consistency between the stated strategy and our market reality. A high dividend not supported by solid growth could prove to be short-lived, so be cautious. Instead, look for a balance between current yield and long-term growth potential. Even if you are tempted by a stock with a promising dividend, avoid concentrating all your money on it. Spreading your investments across multiple sectors and different geographical zones limits the blow if a company goes through a difficult period. No one can predict what awaits the economy. So, it's better to put all the chances on your side. Some firms, businesses, can suffer the impact of a new law, an increase in commodity prices, or an uncertain economic climate. We just saw it a few weeks ago with Apple and the taxes on China by Donald Trump. By informing yourself about these potential obstacles, you protect your ability to receive regular dividends sustainably. The role of leadership and management is sometimes underestimated. Observe their announcements, their recruitment, and their development directions. A management team with a solid track record in dividend payments is often reassuring. On the other hand, if you detect constant reshuffles or controversies related to governance, it can harm investor confidence. Also, review the annual reports where management defends its vision, presents its financing priorities, and discusses the future direction of the dividend. It is a good indicator for assessing the reliability of future yield. Beware of a very high yield that sometimes hides a plummeting stock price. Example, a dividend of 9% may be less attractive than a dividend of 4% if the first company is facing difficulties, major. Do not evaluate solely based on the stated profitability. A more mature company with a more modest dividend can offer better stability and potential appreciation in the long term. To develop a nuanced view, Compare different sources and stay attentive to market announcements. The goal is to find a balance between attractive returns and, of course, investment security. Here we are at the end of this presentation, and I hope you found concrete ideas to strengthen your dividend strategy. The key is to thoroughly research financial solidity and consistent payments without forgetting growth prospects. Keep in mind that every investor has a different profile. Adjust your choices according to your goals. If you enjoyed this content, consider subscribing and subscribe to the channel and like this video so you don't miss the next posts. Thank you for your loyalty and see you very soon for new analysis on dividends.